They say money makes the world go round. History says it drives people insane. People once sold their homes for a flower, not for food, not for land, for a tulip bulb. Fortunes were made and erased overnight, not by war or disaster, but by belief. From tulips to stocks to housing to crypto, every bubble begins the same way. Prices rise, greed spreads, and everyone says the most dangerous words in financial history. This time, it's different. It never is, because bubbles aren't about money. They're about human psychology. And the next one is already forming. They say money makes the world go round. But history tells us something far darker. Money doesn't just move the world forward. At times, it spins the world into madness. Imagine people selling their homes just to buy a single flower bulb. Imagine fortunes rising and collapsing in a single day, not because of war, famine, or invention, but because of collective hysteria over the price of something with no intrinsic value. From tulips in 17th century Holland to NFTs in the 21st century, economic bubbles reveal one of the most dangerous truths in financial history. When greed takes over, reason disappears. And every time, the crowd repeats the same lie. This time, it's different. It never is. To understand bubbles, we first need to understand the fragile psychology of wealth. A bubble always begins with a promise. The promise of quick riches, easy financial freedom, an escape from the grind of ordinary life. In the early stages, it feels rational. Prices rise because demand rises. Investors feel smart, visionary, ahead of the curve. Then momentum builds. More buyers rush in, terrified of missing out. The thing being traded, whether land, stocks, railroads, internet companies, or digital images of apes wearing sunglasses, becomes almost irrelevant. What matters is the belief that someone else will pay more tomorrow. At its core, a bubble isn't about real wealth. It's about the illusion of wealth. And illusions, by definition, always shatter. The most famous example in economic history, the one still taught in classrooms today, is the Dutch tulip mania of the 1630s. 17th century Holland was one of the wealthiest societies on earth. Amsterdam had become a global hub of trade and finance. Dutch ships carried goods from Asia, Africa, and the Americas. The Bank of Amsterdam, founded in 1609, was among the world's first true central banks. People had disposable income, and they were willing to speculate. When tulips arrived from the Ottoman Empire, they were exotic, rare, and fashionable. Owning unusual varieties became a status symbol, much like luxury watches or rare cars today. But soon, tulip bulbs stopped being flowers. They became financial instruments. People bought and sold them not to plant, but to profit. By 1636, traders were buying tulip futures, contracts betting on what bulbs would be worth later. At the peak, a single rare bulb could cost more than a skilled craftsman's annual income. Some reportedly sold for the price of a house. And then, suddenly, it ended. In the winter of 1637, buyers stopped showing up. Confidence cracked. The same bulbs once treated like treasure became worthless overnight. Prices collapsed. The Dutch economy survived. Later stories exaggerated the damage. But for countless individuals, it meant total financial ruin. The lesson was simple and timeless. When price detaches from real utility and survives only on speculation, collapse is inevitable. 2 centuries later, the same human pattern repeated itself in Britain, in what became known as the South Sea Bubble. The South Sea Company was founded in 1711 and granted a monopoly on trade with Spanish South America. The promise was enormous: gold, silver, and riches from the New World. The company even tied itself to government debt, converting Britain's national debt into company shares. As excitement grew, prices exploded. By mid-1720, shares had risen nearly tenfold in less than a year. Members of Parliament, aristocrats, and even the king's mistress invested heavily. But the profits were mostly imaginary. Spain tightly controlled its colonies. Trade was minimal. When reality finally collided with hype, the stock collapsed, destroying thousands of investors. Even Sir Isaac Newton lost a fortune. He later admitted, "I can calculate the motions of heavenly bodies, but not the madness of people." That single sentence explains every bubble in history. The centuries that follow were filled with similar manias: railways, land, gold rushes. Each promised transformation. Each created paper wealth. Each ended in ruin for many. Then came the Roaring Twenties. Between 1924 and 1929, U.S. stock prices tripled. Ordinary Americans bought stocks on margin, borrowing most of the money. Banks, corporations, and households became tightly linked by leverage and illusion. When the crash came in 1929, it wasn't just a market correction. It helped trigger a global depression. Bubbles don't just destroy wealth, they can destroy societies. The pattern repeated again in the late 1990s with the dot-com bubble. The internet was real, just like tulips, railways, and housing were real. But the prices were fantasy. Companies with no profits, sometimes no products, were valued at billions. When it burst, trillions vanished. Yet out of the wreckage came Amazon, Google, and the digital world we live in today. That's the paradox of bubbles. They destroy wealth, but sometimes accelerate progress. The housing bubble of the 2000s was no different. Complex financial products created the illusion of safety. By 2007, people believed house prices could never fall. They were wrong. The 2008 crisis nearly collapsed the global financial system, and its effects still shape our world. Then came the strangest bubbles of all: cryptocurrencies and NFTs. Bitcoin began as an experiment in digital money, but speculation followed. Prices rose not because of adoption, but because of belief. In 2021, Bitcoin neared $70,000. NFTs sold for millions. People convinced themselves that owning a digital image meant owning value itself. Once again, the crash followed. By 2022, over $2 trillion disappeared. Many lost everything. A few insiders walked away rich. So what do all bubbles share? Human psychology, greed, fear, and hope, and systems that enable excess, easy money, leverage, and hype promoted by those who benefit most. Bubbles aren't history. They're happening now. Look around. Markets, housing, speculative tech, central banks flooding systems with money, governments running massive deficits. Ordinary people told once again, don't miss out. History doesn't repeat, but it rhymes, and the rhyme is getting louder. Every bubble follows the same path. Prices outrun reality. Credit expands. Experts insist this time is different. Then confidence breaks, and collapse is sudden. The damage today is greater than ever because the system is more connected, more leveraged, and more fragile. Bubbles used to ruin merchants. Now they destabilize nations. So the question isn't if bubbles end, it's how and who pays the price. And history's answer is cruelly consistent. Ordinary people pay most. Elites usually escape. That is the brutal symmetry of money and power. Every bubble begins with a promise. The promise you can escape history. But history always collects its debt. The choice is simple: chase the illusion, or learn from the past and build something real. Because the next bubble is already forming. The only question is whether you'll be crushed by it or prepared for it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.